evening, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're touching on some earnings of the conglomerate sector. Of course, we're speaking about Ansa McAL, or the Ansa McAL Group, as well as GraceKennedy Limited for their respective 9-month periods ended September 2024. Now, both groups would have reported positive earnings momentum. Let's see what took place and what investors might expect in the coming months ahead. Turning firstly to the Ansa McAL Group, or AMCL, well, the group would have reported diluted earnings per share of $2.01 for that 9-month period ended 2024. Of course, a 23.3% increase from that $1.63 recorded in the prior comparable period. Now, revenues were up just a modest 2.1%, but of course, positive revenue momentum is always welcome, from $5.13 billion to just about $5.24 billion. TT equivalent operating profits up that whopping 16.9% from $494 million to just about $577 million, with ultimately profits for the period increasing 26.3% from just about $324 million to just over that $409 million marker. Now, when we take a look at the contribution by segment to profit before tax for Ansa McAL, we can see that there were some quite notable changes. The construction, manufacturing, packaging, and brewing sector in that reddish color would have increased from 267 to 358 odd million, roughly 34% increase. Positive momentum in the banking and insurance segment as well, moving with profit before taxes of 149 million versus that 127 in the prior comparable period, a 17% odd increase. Some marginal decline in the automotive trading and distribution segment in that orangish color, from declining roughly 5% from 131 million to just about 125 million. And a wider loss for the media services, retail and parent company segment, moving from 57 to a $63 million loss. However, on aggregate, certainly positive momentum in terms of profit before tax for Ansa McAL. And of course, with the recently announced acquisition of Bleach Tech out of Ohio, and certainly some of the guidance provided in terms of earnings momentum and expected earnings contribution, we do anticipate that the construction, manufacturing, packaging, and brewing segment would, of course, increase significantly on consolidation of that new acquisition business, which was quite sizable by any measure, 327 million odd US transaction, or roughly a 2.2 billion TT equivalent transaction, of course, at prevailing official rates. Now, in terms of existing businesses and profitability, well, when we take a look at Ansa McAL's margins, again, moving in the right direction, operating profit margin up 11%, still not quite where pre-COVID operating margins were at around 13%. And of course, that profit before tax margin in that blue segment up to 10.8%, again, below the pre-COVID margin levels, however, trending certainly in the right direction. Now, from an investor perspective or shareholder perspective, we can see that trailing 12-month EPS is again trending in that right direction in the bright green column, with trailing 12-month EPS at around $3.38, and that price to earnings ratio coming down quite considerably from that 9-month period point at 2022, falling from that peak of 27.8 times to 17.7 times. So in terms of the price per share that investors are paying for each dollar of earnings, it is getting much more attractive relative to recent historical trading levels. So at that price of $59.80, again, Ansa McAL is trading at a price earnings ratio of 17.7 times, above the sector average of 12.9 times, with a dividend yield of a reasonable 3%. Pretty much in line or just below marginally the sector average of 3.3%. Now, with that modest revenue growth in mind, however, keeping in mind also those acquisitions and the geographical diversification the group is pursuing, and the meaningful impact that its most recent acquisition is expected to play, those stable dividend payments, but again, tempered currently by those elevated valuations. Bourse is maintaining a market weight rating on AMCL for the time being, of course, with a fairly positive outlook given the acquisition activity that would have just taken place. Turning quickly to GraceKennedy Limited, or GKC, the group would have reported an earnings per share figure of 28 cents TT equivalent, 11.2% higher than the 25 cents TT equivalent reported in that prior comparable period of 2023. Revenues were up 7.3% from 5.02 billion TT equivalent to just about 5.38 billion TT equivalent. Ultimately, net profit attributable to shareholders or equity holders rather, up 11.1% from 254 to 282 million. Now, in terms of the PBT contribution or profit before tax contribution by segment for GKC, also some notable changes. Food trading continues to be the dominant contributor, and that was up around 17 to 18%, moving from 225 million TT equivalent to 261 million. Insurance up also roughly 16 to 17% from 59 million TT equivalent to 70 million. Banking and investments, significant turnaround, although a much smaller contributor to overall PBT for the group, up 85% from 20 million to 37 million TT equivalent, with some modest decline in the money services segment, moving from 102 to 96 million. Of course, that may have, one of the drivers of that might be more restricted access or limited access to foreign exchange, which may have been cramping some of those transactions related to money services transfers and etc. So when we take a look at the margins story for GKC or GraceKennedy, we can see that margins have remained fairly stable, some modest improvement over the prior comparable period, with operating profit margin increasing from 7.5 to 7.7%, and PBT margin also increasing from 7.4 to 7.7%. So certainly trending in the right direction, albeit at a modest pace of improvement. So at a price of $3.65, GKC is trading at a price earnings ratio of 10.2 times, below the sector average, the conglomerate sector average of 12.9 times, and offers investors a dividend yield of 2.8% compared to the sector average of 3.3%. Of course, GKC is one of those companies, few companies on the stock exchange that does pay their dividend in USD. So with that higher revenue in mind, modestly improving margins and relatively attractive valuations, inclusive of that US dollar dividend that investors do receive, Bourse is maintaining its overweight rating on GKC for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.